Hey everyone, welcome to your Algo Lab. In today's session, you'll get a quick recap of last week's major economic releases and market movements, along with a look ahead at the key events coming up next week. Without further ado, let's get started. On Tuesday, the Eurozone released its July inflation and core inflation figures. The core annual inflation remained steady at 2.9%, indicating that disinflation progress in the euro area has slowed recently, even though the overall downward trend continues. This development is likely to support the European Central Bank's cautious approach to future rate cuts. Canada also released its July inflation figures. The slowdown in both headline and core inflation suggests that the Bank of Canada is likely to continue on its rate-cutting path. The deflation in durable and core goods indicates that restrictive monetary policies are starting to impact the real economy. On Wednesday, the US Bureau of Labor Statistics revised its non-farm payroll estimates downward by 818,000 for the 12 months leading up to March 2024. This means that instead of adding 2.9 million jobs during that period, only 2.1 million new jobs were created. The labour market appears weaker than previously reported, and this deterioration could prompt the Federal Reserve to emphasise both sides of its dual mandate. Investors should anticipate the Fed preparing markets for a potential rate cut at the September meeting. The minutes from the July 30th, 31 FOMC meeting suggest that the Federal Reserve is likely to vote for a rate cut at the September meeting. During the July meeting, several policymakers already supported a rate cut, and the vast majority believed a September cut would be appropriate. Based on these minutes, if unemployment continues to deteriorate with the next release on September 6th, there's a possibility of a 50 basis point rate cut, as support for a reduction had already been building in July. On Thursday, the flash Germany PMI was released. According to S&P Global, the manufacturing PMI dropped to 42.1, marking a 5-month low. On Friday, Japan released its July CPI figures, revealing hotter than expected inflation driven by a broad range of factors, aligning with the Bank of Japan's view that inflationary pressures are expanding. The report provides further evidence that wage increases from the spring wage negotiations are contributing to rising service prices. Additionally, the stronger price gains in household durables likely reflect higher import costs due to a weaker yen. Stocks surged across the board, and bond yields tumbled after Jerome Powell signaled that the Federal Reserve is likely to begin cutting interest rates in September. All major sectors in the S&P 500 rose, with the index climbing 1.45% for the week. The Russell 2000, representing small-cap firms, gained 3.58%. Stocks in Europe and Canada followed the US lead and also posted gains. Investors are now considering whether another weak employment report could prompt the Fed to cut rates by a larger than usual 50 basis points. In the bond market, treasuries rallied, particularly in shorter maturities, with the 2-year yield dropping below 4%. The dollar declined by 1.7% over the week, while Bitcoin saw gains. Looking ahead to next week, on Monday we'll see the release of durable goods orders. On Tuesday, the Conference Board Consumer Confidence Report will be released. In July, consumers' assessment of current labour market conditions worsened, and this trend could continue into August. On Thursday, the second estimate of Q2 US GDP will be published. Real GDP for Q2 might be revised slightly lower in this update, as most related data have undergone downward revisions. On Friday, we have the release of personal income and spending. July's monthly PCE inflation data is expected to align with the Fed's 2% inflation target for the fourth consecutive month. Additionally, the final print of the Michigan Consumer Sentiment Report will be available. The preliminary estimate showed improvement influenced by developments in the US presidential election, but the final reading could be revised downward due to weakening job and income conditions. Lastly, let's turn to the Central Bank Watch. Here, we review recent rate decisions and highlight what the market is currently predicting for future actions. It's important to note that economists' forecasted rate cuts may differ from those implied by the market. The market is expecting a total of 4.1 cuts by the Fed, or 1.03%, up from 3.8 cuts, or 0.95% a week ago. On this channel, we share tested strategies for investing and trading, covering everything from technical analysis and fundamentals to economic trends and sentiment-based algorithms. If you don't want to miss out on any of our content, be sure to like, subscribe, and hit the bell icon to stay in the loop. Thanks for watching, and I'll see you in the next video.